All right. What's going on, tycoons? Super excited for today's video. We're going to be taking a look at the Snapchat chart. Okay. So SNAP. And I'm going to be going over with you guys one of the many strategies you guys can use to make money during a bear market. Okay. Now, why am I saying during a bear market? Well, because if you look recently in September, okay, so just like 3 months ago, Snapchat was trading at $83. Today, it's currently trading at 30. Okay. So that's the reason we're bringing it up. A lot of these tech stocks, a lot of growth stocks and things like that are in bear market territory. Okay. They've been beat down. They can drop lower. There's always that risk, but it is a very good time to start paying attention to a lot of the big name stocks that you like. Okay. Now, and when I say big name, that doesn't have to mean Apple, right? You don't have to go and buy out $1 trillion market cap stock, right? You can look at other things like Snapchat. You can look at penny stocks. You can look at small caps. You can look at new things like Lucid, whatever it is. I'm going to show you guys a really great strategy today on how to make money, all right, during this bear market. All right. What you want to do, the strategy we're going to go over today is known as selling puts. Okay. So essentially the strategy behind this is let's say I have $10,000 I want to invest in the stock market, right? And I'm looking to put a good amount of that into Snapchat, right? So Snapchat's at $30 a share. If you were to purchase 100 shares right now, that would be like $3,000. Okay. So what you can do is if you have $3,000 or if you have a margin account, now using margin is always very risky. So do that according to you, but you can pull up the option chain. And what you can do, especially on red days, okay, big red days. Snapchat is down 4.5% today. That is a pretty big red day. Okay. What you want to do is on these red days, you want to come choose a price that you want to actually own Snapchat at. So it's at $30 right now. Me, let's say I want 25. I want to be able to buy it at $25 a share. I'm going to go to the June 2022 contracts, right? Which is about 5 months from now. Okay. And we're going to go to the 25 strike. And if you sell one of these, okay, you will currently get about $295. Okay. So we'll look here. And that's if you sell it. So that will be an instant credit that goes to your account and you can withdraw it immediately. And go buy some beer with it, right? Or go buy a new laptop, to be able to trade on a desktop versus just using your phone, right? Okay. Or you can save that money cash and wait to see what happens at the expiration date, right? Because at the expiration date, if Snapchat is below is at $25 or below, then your option contract will be executed and you'll be forced to purchase 100 shares at $25, right? But so let's do some math real quick, okay? So that's 100 shares at $25 is $2,500. All right. You got credited $295 for purchasing that contract. So really your price is going to be 2,500 minus that 295 that you got. All right. So that's really going to be you owning 100 shares of Snapchat for a cost basis of close to $22 a share. Right. So that's really, really nice. And that is a very, very useful strategy that you guys can use, for this. But the main thing is you have to be willing to purchase the shares at the strike price, right? Because what happens if Snapchat falls all the way down to 20 or 19? Now your contract is still going to be forced to execute and you're going to buy 100 shares at $25 minus the 300 credit. All right. So basically a $22 a share roughly, right? But you're taking an immediate $300 loss because now it's at $19 a share. And so, you were forced to buy at 25. You got that credit. So it put your cost basis down to 22. Now you're taking a hit. But if you're not worried about taking a small $3 hit on Snapchat, and you're not worried that, hey, you know what, it's at 19 right now in June, but I know that in June of 2030, Snapchat's going to be probably $100. So I'm perfectly fine with buying it at 22 and it being at 19 right now. So you have to develop that on your own, right? Your own risk tolerance, right? So this is the farther out you go, the more expensive the contracts get. And then also the closer to expiration, kind of the more expensive the contracts get, if that makes sense, right? Because if you look here, the 25 strike for June is about 290 to 300, right? And then if we go to February and look at the 25 strike, it's only worth 140 to 145, right? And then we go to January 28th, which is this upcoming Friday, and the 25 put is only worth $18, right? So, you get more money the farther out that you go, right? But you can come in here and sell relatively low risk weekly options, meaning every week you sell an option against it and earn money every week, right? And you don't have to worry about it being executed, right? What you can do is you can actually go to um, probability in the money and out the money, right? So if you go to your layout and then you go to customize, what you can do is you can search in the columns and you can go to prob, right? And it'll pull up your probability of in the money, right? That's what ITM stands for. Your probability of touching and your probability of out of the money, right? Um, Now, these are some of the things that I like to look at personally whenever I am looking to sell some puts, right? I want to see what's the probability that this contract is going to expire worthless, right? Because if you're looking to not purchase 100 shares, right? And you're looking to really just sell puts against it, right? You want to sell high probability out of the money by expiration puts. So if you can find something that's like 85 cents or higher, 85% or higher, those are really good odds. Okay. And the odds are that, hey, there's an 85% chance that if you sell the 26 strike put for January 28th this week, that contract is going to expire worthless, meaning that you get to keep the full value of the credit that you received without having to purchase any shares or do anything at all. So essentially, it's a free $25, right? Now, what it takes is $2,600 worth of capital, right? Either margin or in cash. So that's why it's called cash secured puts, because you need to have the money to buy 100 shares at $26 a share if that contract does happen to get in the money by expiration. Okay. So there's a 14.85% that this thing is going to execute. So you need to have $2,600 in your account. So that way, in case that 15% chance does happen and it does execute, you're able to complete the fulfillment of the option contract, which is, a legal binding contract, right? So, I would really suggest this for a lot of you guys' favorite positions right now. Either sell some weekly call options, or I'm sorry, put options, and collect a little bit of money on them, right, while things are going down. And on down days when things are down red, the put premium is going to be really high, so you'll be able to sell it for a higher price. And then whenever it goes green, the price of that is going to drop, right? So that's what you want to happen when you're selling puts. Okay, you want it to expire worthless, or you want it to expire in the money at the strike that you desired, and you don't really want it going much below that, right? If it goes below that, below your strike price, then you need to be comfortable emotionally with the investment going forward, right? Because your contract, is going to be to purchase 100 shares at whatever strike you choose. And if let's say you choose a strike price of 30, and the stock is at 20 by the time your contract expires, you're going to be buying the stock 50% higher than what the current price is. So keep that in mind. All right. So if you found anything useful or helpful in this video, please let me know. Don't forget to like, comment, and subscribe as well. And I'm out.